Is having no money getting in the way of you buying real estate? Well, when I first started in real estate, I had no money either, but I didn't let that get in the way. So I'm going to help you understand the fundamentals of capital raising so that you too can go out there and invest in real estate. My very first property was my toughest investment because I didn't have any money. So I had to borrow money in order to make it happen. The first investment that I made was in myself. So I invested in education, mentorship, and community. And what that did is that it gave me the confidence, first of all, because I felt like I knew enough to move forward. It also gave me the support of the community. So if I needed a question answered, if I needed a contact, I had it. And of course, it gave me a team. I built a power team so that I could move forward and do that. I secured a single family home, which I did a flip to yourself. That's what we call it, a key spire. And where basically I just converted a single family home into a duplex, increased the value, got a new mortgage on it, and pulled out the extra cash to pay back the private loan that I used to do everything, acquire the property, do the renovations. And what I realized was that I could now scale and I could get in the real estate game without having to put my own money in. Actually, I even preferred this as a business model. Even when I do have money, I still don't use my own money to invest in real estate. I use my own money for things that I want because I have a scalable business model by using other people's money. And by doing so, I realized that there was money everywhere. There's institution money with banks. There are more than 5 banks, by the way. There are a lot of banks out there. There's B lenders, there's bridge loans, credit unions, there's private equity, there's private lenders, there's registered funds. Did you know that you can use your RSPs to invest in real estate? And so there's also your own money, which is the first place that we all go to invest in real estate. But these are all sources of capital that I want to walk you through today. So over the next couple minutes, I'm going to point out the different sources of capital that you could potentially draw from. So let's get to it. First of all, you need to figure out, are you borrowing debt or are you using equity? Because there's 2 types of partners out there. One private lender will give you money in exchange for an interest rate, and another private lender will give you money in exchange for equity rather than an interest rate. So your deal should be designed around this. Is there enough of a lift to pay back the lender? So you should consider a joint venture partnership where rather than having them loan you money for an exchange interest rate, you have them come in for equity. I not want to use my own money. I said earlier I wouldn't even use my own money. It's because it's too slow and I can't scale. And if I'm just going to use my own money to buy property, then I'm not going to acquire a lot of properties. And there's an inherent risk to that. If I only get 1-2 properties every 1 or 2 years rather than 8 or 10 or 12 every year, then I'm not diversified. And there's an inherent risk there. So learning how to capital raise is the single most important skill that I have. Why do I feel that way? Well, I think the simple answer is that I feel that you could literally drop me off anywhere in the world, and within 2 years, I will have built a small portfolio. And that's incredible because it took me 45 years or whatever to get to this point, whereas I can get to this point now in a matter of 2 years. So if you're going to be raising capital, then there are some sources that you should know about. Number 1, using your own money. As I mentioned earlier, this is the first place that people go to is in their own bank accounts to borrow or to use money for investing in real estate. The problem with this is that it's too slow. Yeah, sure, I would love to own 100% of that apartment building, but I'm never ever going to save enough money to buy that apartment building with my own money. And just waiting around for that day to come isn't an option. And furthermore, if I'm into residential mortgages, for example, and I want to get 5 homes or short-term rentals, I'm going to run into a wall with the bank. And that's a problem too, because the bank's not going to want to give me any more mortgages. And I've used all my money and I'm working, I'm painting the baseboards, I'm evicting the tenants, and I'm doing all of this. I would rather use my own money for my own things that I want to enjoy, trips, food, vacations, whatever it is. And if I have extra money in my bank account, I'm not going to just leave it in my bank account to lose 3 to 6%. I'm going to invest it passively, but I want my money working hard for me. I don't want my money working hard while I'm working hard. I'd rather just partner up with someone that knows what they're doing, because then I'm mitigating the risks as well. And they're working my money for me, and my money is making money while I'm sleeping. Number two, another source of income for investing in real estate is registered funds. Crazy. You can use your RSPs to invest in real estate. You can use your LIRA. There's the tax-free savings account. But it's not as simple as just collapsing your registered funds, taking that money out, because that's a no-no. There's a way to go about it. You can use a third-party trust. You can use a third-party trust company to redirect your registered funds. And there are rules and regulations, and it's highly regulated. But if you've got the right support, if you got the right person there, if you've got the right deal to redirect that money into, then you're laughing, you're good. You should absolutely use your RSPs to invest in real estate. Number three, private money. This is how I got into my first investment. There was enough lift in order for me to pay back the private lender after a year, which is why I use private money. I found an opportunity, I identified the opportunity, I turned a liability into an asset, whereas most people would have taken this single family home and just put a single family into it and have it negative cash flow and just wait for the market to do its thing. Whereas I am not investing in a non-cash flowing property. That is not a good idea. So, but in order to do this method, you need to do a lot of work. You either need to find a property that is so underperforming, or it's just so run down. It's just, and then you're going to lift it up so much that you're able to pay back your private lenders. That is a really good way of getting into real estate. But again, you got to learn how to identify those opportunities. And with the private lender, you can set it up in many ways where, let's say, for me, it was a $50,000 loan and it was a 1-year term. So I drew up a document that just said, I'm going to pay you back after 1 year. I'm going to pay you 12% annualized, interest-only payments monthly. And you can do this quarterly. You can pay them interest payments at the end of the term. You can pay them interest payments right up front as well. So it's like, here's the interest, all the interest you would have made from that year. At the end of the year, I'm going to give you your initial money back. But you need to have a solid plan in order to do that. If you're not able to do that, or if you're unsure whether your project will have an after repair value high enough to pay back your private lending deal, then you're probably going to want to look at this source of capital, which is private equity. I love private equity because here you get to enjoy the wealth of real estate and the equity and everything that real estate provides with your partners. So they're coming in, they're bringing the money, but me and my team are the experts, and we're going to run the asset. And running the asset is huge. It's not an easy thing to do. And for me, it takes a team of people to do it right. Reconcile the books, oversee the turnover of tenants, the renovations. There's a lot to do there. And my money partners don't have the time to do that. So what they do is they're like, okay, you found this property, you've run the numbers, I trust your team, your boots on the ground, everything's solid. So I'm just going to park my money with you, and I'm going to go back to work. I'm going to do my thing. When you've turned over the building and it starts performing, let's see some cash flow. Perhaps after a year or two, you can do a refinance and get some of the money back. And if that type of structure, if I see an opportunity that has that type of structure, I'll go for a JV deal, and I will go for private equity. And so that's another source of income that you should consider as well. All right, another source of capital could be from a bank. Everyone knows that. A bank can give you a mortgage, it can give you a line of credit, a home line of credit, but you need to realize that there are more banks than just your typical 5. There are a lot of banks out there, and there are a lot of options, And another option is a credit union. So what's a credit union? Credit union is basically a nonprofit company where they share their earnings with their members rather than a bank, which is profit orientated. Now, another cool thing that institutions offer is a CMHC insured mortgage. And I've used this before. For my first property, I put in 5% down because putting a $21,000 down payment was a lot more doable than putting an $80,000 payment in. The problem with that was that it's very restricted. Like I had to have a 5-year fixed mortgage. What else was there? Oh yeah, I couldn't amortize over 30 years. I had to amortize over 25 years. And that's another thing too, is that most people are in a hurry to pay off their mortgage. But I'll take a longer amortization if it's going to lower my monthly payments because I'm looking for that cash flow, and anything that can improve the cash flow is a win in my books. So a CMHC insured mortgage is great for residential mortgages, and it's also good for multifamily, and especially for land development. In recent years, they've come out with very appealing terms and conditions for building because they're trying to encourage building. And there are some cases that you can get 95% loan to value, 50 years amortization, and really low interest rates. And these are very appealing terms. So you need to understand, am I going to a bank? Am I going to a B lender? Am I going to a credit union? Or am I using a CMHC insured mortgage? Having an understanding and grasp of all these sources of capital will help you structure your deals. All right, so now that you understand what different sources of capital that you could draw from, there's no reason for you to go out there, identify an opportunity, understand how to turn that liability into an asset, and figure out what sources of income you are going to use. If you enjoyed this video, hit the subscribe button, hit the like button, join me on social media, and I'll see you again.